Hi everyone, welcome back to the Joyful Investors channel. Today's topic is one of the most important topics that all new investors should know to avoid risking your portfolio. In investing, you definitely would have seen or heard of the terms leverage or margin. Or in fact, when you first open a brokerage account, you will have to choose between opening a cash account or a margin account. Yet there are many investors who do not know how margin works, and it can be really dangerous if you do not know how it works. To begin with, leverage in the finance field is using borrowed capital for investment to maximize your profits. Here is how it works. If you buy stocks on margin, you will only need to pay a portion of the total amount of money that you otherwise have to pay if there had not been a leverage. So the remaining portion of the money will be paid by the brokerage firm in the form of a credit extension to you. But of course, there's no free money in the world. You will be charged an interest charge monthly based on the amount that you have borrowed. So why do some investors like to buy on margin? We can understand this better through a numerical example. In this example, we assume a margin requirement of 50% for easy illustration and a margin account with 5,000 cash. Let's say you want to buy 1,000 units of stock A at $10 per share, and you decide to buy those shares on margin by taking a margin loan of $5,000 from your brokerage firm. 1 month later, the stock price rose to $12 per share. The stocks in our portfolio now stand at $12,000 in total, and we wish to sell the shares now to realize the paper gains. Recall that you borrowed $5,000 from the brokerage firm at the start. So after repaying that amount, your take-home money becomes $7,000. Accordingly, you earned a profit of $2,000, which gives a ROI of 14%. Comparatively, if you had bought those shares entirely out of your own pocket, you still earn a profit of $2,000, but at an ROI of 20%. Buying on margin allows you to double your return on investment by starting off with a smaller capital. So do you now see why some investors want to buy shares on margin? Because it allows them to leverage and buy shares that they will otherwise not be able to afford to. And this is the same reasoning behind why businesses want to take out bank loans to inject more funds into the business so that they can capitalize on a larger pool of funds to expand their business through ways that would not be possible without the bank loan. Furthermore, it allows investors to utilize the money more efficiently. Sometimes it is not that these investors do not have that money to buy the shares. It is that they see this as an opportunity to grow their money. So by borrowing $5,000 from the brokerage firm, they can put their own $5,000 into another investment, say stock B, to earn returns. But of course, this comes with risk. In our previous example, we show how the ROI can double when the share prices increase. But what happens if the share price now drops to $8 per share and you decide to sell off all your positions? With leveraging, you take home $3,000, which is 40% loss on investment. Without leveraging, you take home $8,000, and that is 20% loss on investment. Thus, you may see that when you're on margin, it can potentially double your ROI or even double your losses. Well, some people may opine that the absolute amount of losses is the same for both scenarios, with and without leverage. And not to forget that we also put in the other $5,000 into another investment, stock B, which may yield good returns that can offset the losses of stock A. But we have to be very careful here. What if stock B investment is also losing money? Then there is a risk that you do not meet the margin requirements set by your brokerage firm. And when this happens, you'll be issued a margin call. A margin call is a situation in which the value of your margin account falls below the account's maintenance margin requirement. So what happens when you are issued a margin call? You can either choose to top up cash to your account within the stipulated time frame that is given by your brokerage firm, or you will have to sell off some of your holdings in a portfolio. So if you do not have sufficient cash to top up to your account within the time frame given, then you will be forced to go by the second option, which is to liquidate some or even all of your portfolio. And this can be really risky because Oftentimes, it involves selling your holdings or selling your shares at a price that is at a disadvantaged price or sometimes even at a loss. And you know it can be really frustrating to see the share prices increase just right after you sold off all your portfolio. So how do you see if you are meeting the margin requirement? The best way is to contact your respective brokerage firms to find out the easiest way that you can check for yourself. For example, even though TD Ameritrade published a guidance with a clear illustration on how to compute whether a maintenance call will be issued, the easiest way, according to their customer service, is to just navigate to your account summary to check that the available funds for trading is maintained above $0 balance if you're just buying and selling stocks. For TD Ameritrade, you'll be given 4 days to top up cash to your account when you're issued a margin call. And this time frame given may be shortened depending on the urgency of the margin call. And do take note that different brokerage firms give a different time frame for you to top up cash to your account. So with all that I have shared on leverage and margin, what is my personal take on buying stocks on margin? Personally, I am a rather conservative investor, so I try not to buy stocks on margin. Even if sometimes I do have to tap on the credit given by the brokerage firm, I always make it a habit to ensure that I top up cash to my account within the next few days. But I'm not saying that buying a margin is wrong. So if you're an investor who is alright to take up more risk for more return, then you can always tap on the margin to help you improve on your ROI. My advice is to always do the administrative work upfront, such as checking on how you can do a self-check on the margin requirement or understanding on what is the time frame that is given by the respective brokerage firm to top up cash to your account. You definitely do not want to be caught up in a panic when you're issued a margin call. This information can be obtained easily from the website of the brokerage firms, or they can be obtained with just a call. Always ensure that you have some free cash set aside to protect yourself, as you do not want to be forced to liquidate all of your holdings at a disadvantaged price. The bottom line is not to meddle with things that you are unfamiliar with. So if you do not understand how leverage works, then it is best that you do some research on it, or if you want to see how it works in practice, then you can try it out on a demo account. So after some time, you will be able to gauge for yourself whether you are comfortable with using margin and leverage. We have come to the end of today's video, and we hope that the information we have compiled for you has given you a clearer understanding on how leverage and margin works. Do leave a comment to let us know what other topics you want us to cover, and remember to hit the like and subscribe button. So see you in our next video.